Welcome to Poor Millionaires. Today's guest is Swen Lorenz. Sven is CEO of Sarnia Asset Management and author of Undervalued Shares, where he uncovers overlooked investing ideas that are off the beaten track. Today we'll be discussing the opportunity in European equity markets, where some big structural changes could bode well for investor sentiment after more than a decade of being overshadowed by the US. Poor Millionaires is a show for people with investable wealth of $1 to $20 million. We strive to educate, connect, and inspire, to give you the tools you need to thrive and secure lasting prosperity for yourself and for your family. PoorMillionaires.com. Invest with ambition. This podcast is for educational purposes only. The information does not constitute financial advice or recommendation and should not be considered as such. Value of investments and any income derived from them can fall as well as rise, and you may not get back the original amount you invested. Swen Lorenz, welcome back to the show.
Hi, James. It's great to be back, and congratulations on all the recent podcasts. I've listened to them, obviously, and all I can say is to anyone who's listening now, if whatever I'm saying is not of interest to you, check back to the other podcasts because you're getting some great content here in your library.
You're too kind, Sven. It's good to have you back on the show. Last time you were here, you were speaking about the generational opportunity in small caps, as you called it. This time you're here to talk about European equities, which have kind of been a little bit of a sideshow in recent years, because obviously the US market has been, driving the global stock market, and everybody's just been obsessed with the Magnificent Seven. So what is it about the European equity markets that interests you at the moment?
So for many years, if you've mentioned European equity markets to anyone, they just yawned. They thought this is a low growth area. The stocks there are really boring compared to the performance that American stocks have been achieving. And of course, that was absolutely spot on, but it looks like the tide is turning when it comes to European equities. And there's been a lot of, first of all, progress recently, but the whole situation, the setup has changed, and we may be in for something that will now change. Well, we may see a different situation for years to come. And I think that's an interesting subject to dissect. There are quite a few aspects to it. I hope we're going to present some interesting stats and anecdotes in this podcast that people will feel they haven't come across before yet, and which is going to broaden their horizon. So in short, I think European equities are something to be very aware of, if only for risk diversification as well, and quite probably also to just increase your chance of generating that elusive alpha, that outperformance of general markets. So let's dive into that in more detail this time.
Great. So give us a snapshot of the European equity market landscape then, because obviously it's not a homogeneous market. You've got many different countries in there. Perceptions of European equities are presumably, not great. In terms of, you look at the valuations, there's a big discrepancy with European valuations versus US valuations, for instance. So just give us a bit of a broad overview of what's going on there.
Well, for a start, I think generally speaking, when it comes to Europe, the situation is often better in reality than what you'd think it is when you check on the media. So yes, of course, Europe is now infamous for being relatively low in innovation and all the great tech companies in the States. That's all correct. But for example, in healthcare, 20 of the 20 largest healthcare companies in the world, 8 are from Europe. And we're speaking about world-class pharmaceutical companies. Everyone's been going wild about Ozempic recently, about that weight loss drug. And that was created by a company from Denmark, by Novo Nordisk. And Novo Nordisk, at least for a while, actually became the most valuable company in Europe, worth in the hundreds of billions. So it's not like there weren't success stories in Europe as well. And there's some very high quality companies here. And that's something to be aware of and also take advantage of. But when it comes to Europe broadly as a place where to look at equities, it's always worth keeping in mind there are probably around 40 countries. It always depends on how you count. Do you count the little countries like Liechtenstein? Do you only count the European Union, which is 28 countries? But then you've got all these sort of outliers and separate cases, which, for example, Norway is not part of the European Union. Famously, the United Kingdom is not part of the European Union anymore. It's a very big set of countries. It's very diverse. You have language hurdles. You have different cultures. You've got different equity market regimes. So it takes a bit more of a specialist approach than the United States, where everything is one big pool of companies. And speaking of pool of companies, there are thousands of companies, and actually tens of thousands. If you just take the bigger ones, the mid caps and the large caps, you're still looking at well over 2,500 companies. And I bet to anyone that in a pool of 2,500 companies, there will be hidden opportunities, and the sort of opportunities that, fit someone's profile depending on what they're looking for. And it's really this diversity that we're looking at, which we want to exploit to our benefit.
So that's kind of like dealt with the sort of bottom up analysis sort of side of things. But what about like the macroeconomic issues faced by Europe? So everybody's kind of aware of the sovereign debt crisis that happened just over a decade ago. Europe's still got these structural issues. And what's to stop those from kind of kicking off again in future? And what implications might that have for the market?
So you're touching on something that most investors, this is one of the biggest mistakes that most investors make when it comes to Europe, especially. They see structural issues as primarily a risk when really it's primarily an opportunity. Speak of sovereign debt crisis, which is obviously Greece is the most famous example for that. This year, Greece is the best performing stock market in Europe and one of the best performing ones in the world. And it's been performing really well for quite a few years now. And of course, what you should have done is invest in Greece 10 years ago when this house was on fire. You should have run into the fire when everyone else was running away. And you would have made an absolute killing buying into, for example, Greek banks at their very lowest point, or other Greek quality companies that were available for a song. Problems are always opportunities if the problems are going to be resolved. And Europe may be a bit slower moving, but on occasions you get outstandingly good companies at absolutely outrageous prices. And much as Greece may be a little bit of a niche because it's not the world's biggest market and it's not exactly a large stock market either, although it's certainly large enough to be investing there, in a very serious way. I think we're currently looking at a turning point for all of Europe when it comes to their fiscal policies. And that's really what's going to drive equity market prices over here in the next couple of years. So I'm the biggest fan of the United States, and I'm not going to trash America, and I don't think it's an either or story. You can invest in the United States and in Europe, and one does not exclude the other. It's worth keeping in mind that in the United States, during the Biden administration, they were running huge fiscal deficits to the degree of 8% of GDP. And that's certainly been driving earnings of companies, which in turn has been driving stock markets. That's currently at a bit of a limit, to put it mildly, because that's fiscally just absolutely unsustainable. So you're probably looking at fiscal policies in the United States becoming more restrictive, whereas in Europe, they're becoming looser. So this whole stimulus thing, which you can look at politically, in any way you like, and whether it's really fair to put a debt burden on future generation is a separate subject. But when governments unleash fiscal stimulus, then you know what happens to stocks. And that's what's going to happen in Europe now, thanks to the new administration in the United States, putting a lot of pressure on Europe. The American defense umbrella is not going to be quite as guaranteed in the future as it was in the past. So European companies, European governments are now looking at spending on defense again. And it all started with the Germans, who have a very conservative balance sheet as far as the country is concerned. So far, Germany only had debt that amounted to about 60% of GDP, compared to, for example, it's 100% in the United States now, it's 96% in the UK. Japan, crazily enough, it's 200% of GDP. And the Germans have now made the executive decision to take the debt to GDP ratio from 60% to 80% and spend that money on infrastructure, which means defense, it means bridges, highways, railway systems, but it also means digital infrastructure. And that's over €1 trillion that's going to be spent over a period of 10 to 12 years. It's going to add 1% per annum to German GDP growth every year, which if you are growing at 1.5%, then to add another 1% takes you to 2.5%, which is a 67% acceleration relative to how you've been growing in the past. And that's going to be amazing for some companies. And we want to identify what these companies are and benefit from it in the same way that investors in American equities have been benefiting from under the Biden administration. It's to some extent it's fiscal hocus pocus, but as investors, when there is helicopter money being thrown from the sky, you just run outside with a bucket and you try to catch as much of it as possible.
So I guess the defence companies. I mean, we've already seen companies such as BAE Systems and what's the one in Germany, Rheinmetall. Sort of the share prices have gone ballistic. So I guess investors have maybe missed that boat already. But in terms of the other sort of sectors that we might want to be looking at, I mean, you mentioned infrastructure. What about kind of like consumer sort of cyclical stuff as well? Should we be looking further afield?
So I'd be looking at. I'll give you two examples. I'll start with a slightly more boring one, and then I'll wheel out the more exciting one. So the seemingly slightly more boring one, but which has been very interesting, continues to be interesting, and also is a bit of a good model case for what we're speaking about, is European telecom companies, which probably sounds about as boring as it gets. But what's been happening in European telecom in that sector is we currently have over 100 telecom companies across Europe, which is absolutely crazy when you compare to, for example, the States, where you've got a handful of them. So there is consolidation is necessary, and it's now politically desired. It's something I wrote about 2 years ago, and I told people to look at Austria Telecom, which in the meantime, the stock of that has doubled, and it's a very conservative stock. So for that stock to double, is quite a significant performance. It had very limited downside. It's now up in value a lot. And this shows the sort of specialist approach you have to take when it comes to Europe. It's not like people wake up in the morning and think of, I need to look at the European telecom sector. You need to do a lot of digging and really dedicate a lot of work to finding these opportunities. And there'll be more of them. I'm just citing them as one example that's already well underway. And something that I think is going to provide a lot of excitement in the next couple of years, and the opportunity for multi-baggers and significant alpha, is the digitization of Europe's infrastructure and the digitization of government and of companies in Europe, where the continent is, first of all, behind objectively. And secondly, I think they will be looking to build some national champions, not as in state-owned companies, but rather through giving, placing orders placing orders with European companies that are domestically grown. And especially in Germany, I think there are quite a few hidden champions among publicly listed companies that can build and provide this digital infrastructure, and which could grow by a multiple. So we've already seen some of them, but it's not something that's in the public eye just yet. And these companies are a bit harder to filter out and to identify. And I think that's where we're going to see some amazing action. And again, this is quite typical of what you could find in Europe if you know where to look.
So I think one of the biggest hurdles that investors have to overcome when it comes to Europe is the fact that there are so many different cultures, languages, legal systems in Europe that it can be quite daunting for, say, for example, like a US investor to come and start looking at these these different markets. So what would you say to investors in that regard? What's how would investors overcome that problem?
Well, again, for a start, difficulty and complexity is an opportunity if you know how to overcome it. And this has been quite brilliantly described recently in a report from Goldman Sachs, which I'm very happy to share with anyone who sends me an email and asks for it. So Goldman Sachs has been analyzing how information disseminates much more slowly in Europe. So why is that a good thing? Because when a publicly listed company releases news, then it takes the market longer to fully price in that news. And that's also due to the fact that you simply have fewer analysts following European companies. And the figures that Goldman Sachs cited were actually quite astonishing. So nowadays you have more analysts on average. You have more analysts following companies in emerging markets than in Europe.
Wow.
So that summarizes the whole situation. Europe has just been so out for so long that companies have stopped, analysts and investment banks have stopped covering companies.
And
So
the new MiFID rules that came into force, does that have a bearing as well?
exactly, yeah. MiFID, that really technical regulation that was supposed to protect investors, but again has sort of done the opposite by making sure that there's less analyst coverage. It's a whole subject unto itself. But in a way, Europe is just undercovered, underanalyzed, and whereas in the States, everything is just completely grazed over. In Europe, the opposite is the case. It's also true with media. Europe has less media and information disseminates more slowly. Again, Goldman Sachs has measured all of that and has provided some really fascinating statistics on it. For investors who have the wherewithal to follow developments in Europe and among European companies and who can act more quickly, that's a huge opportunity. And people can either do that themselves. You can read lots of Substacks, analyze companies yourself, or you can give money to a fund manager who does that for you. There are always these two options, and different things work for different investors, but all options are available.
So, which countries in particular catch your eye right now, then, Sven? Because I mean, you mentioned Greece, obviously being a really great performer over the past year or so. What other markets might we want to investigate at the moment? Do you think?
I think investors should create a basket of stocks from Europe, and I see Europe very much as a diversification opportunity, especially for American investors. I know a lot of American investors who have 100% of their money invested at home, and the dollar has been becoming a lot weaker of late, and currency cycles tend to go in very long stretches. So the dollar has now been quite strong for 14 years, and a weaker period for the dollar is overdue and may even be politically desired. There's also just simply the fact that you should never put all your eggs in one basket. And much as it seems like the United States has a stock market that only ever goes up, historically, of course, that's not been true. And if you go back to the Second World War and you look at the different decades, as it turns out, and that may be surprising to a lot of listeners, in the 8 decades since the end of the Second World War, American equities have outperformed international markets in 4 of those decades, and international equities have outperformed American equities in the other 4 decades. And there was actually a period in the 1970s and 80s when international equities outperformed the American market for 20 years, for 2 decades. So if you were just heavily overweight on the United States, for 2 decades, you were behind. And I'm not saying that the next 10 years are going to be anything like it. All I'm saying is that, hey, American friends, you should diversify and not just place 100% of your money on your domestic market, because that is probably not a good risk weighting and not a good diversification strategy. With that said, I also think you shouldn't place all your eggs in one basket when it comes to Europe. There are very distinct, very different opportunities available in Europe, and they may take a different period of time to materialize. And I would say, broadly speaking, I currently see a huge opportunity in Germany because of what Germany is doing fiscally and because of the digitization of infrastructure in Germany. That's number one. I'd say another big opportunity is probably around the Mediterranean. It's that area that had huge structural problems and a sovereign debt crisis to some extent 15 years ago. And these countries are nowadays actually they're the better behaved children in school right now, in the sense that they've got their house in order. And Spain, Italy, on the fringes, you've got Portugal down there, you've got Greece in the mix. These are very interesting countries to invest in. And last but not least, I would say the United Kingdom is definitely worth a look because British stocks are currently cheap. It's a very open market. So foreign investors can go into the United States and quite easily take over bids for entire companies. And that's happening in astonishing numbers. And American investors naturally come to the United States first. So I'd say Germany, pillar number 1, everything around the Mediterranean, pillar number 2, and then the UK, pillar number 3. That's a good idea for a basket. And yeah, then the world's really your oyster. You can also, if you want to, you can focus on just any one region or country in Europe. But my advice for anyone who's looking for risk diversification and hoping for a lot of upside from generating alpha, I think should just spread their bets around. And Europe is quite large and very diverse. There's so much to do. That's before we've started to speak about, Eastern Europe and the potential opportunity of rebuilding Ukraine at some point. This is a theme that I think is now going to stay back. It's going to be back in conversation, not just this year. This is going to be an ongoing thing for the next couple of years, if not possibly a decade.
So, as a US investor, then, what's the best way to access the European market? Because, I mean, presumably, a passive ETF is probably not the best way to go, given that you've been talking about, the fact that this is a stock pickers market, and there's a lot of kind of, if you do your research, there are bargains to be sort of to be uncovered. Presumably, active fund management is a good option in that scenario. So, what would you say about that?
Absolutely. And once again, I'm referencing the work of Goldman Sachs. They have also included in that document that I mentioned a statistic about how 74% of active fund managers in Europe have outperformed the market in the last 10 years, which is very much a result of, in Europe, being an active fund manager because of what we described earlier, information traveling so slowly and markets being not very transparent and grazed over. Being an active fund manager in Europe is, I don't want to say it's shooting fish in a barrel, but it is just a market where you have a much higher opportunity for generating alpha out of being an active fund manager. I myself actually represent a fund that has generated significant outperformance over the last couple of years, and that's on the website of my company called Sarnia Asset Management, and it's not part of the podcast, so people have to go to my company's website and read separately about it. But to cut a long story short, I think picking one or two active fund managers who really know their way around Europe, and ideally, they should be based there as well. I think for most investors, that's probably a really good way forward. And then stock picking. And, wearing my other hat, I write a blog called undervaluedshares.com. I report a lot about European equities. And for many years, I slowed down the growth of my readership because writing about European equities was not particularly in fashion. And currently my subscription numbers are going up very nicely because so many people, especially from the United States, are starting to read about stock picking in Europe. All the signs are there, is all I can say. And there are many ways that lead to Rome. People have to define, working with their financial advisors, what's the right path for them. That's not up to me to tell them. I can just point out a couple of opportunities and different ways how to go about it.
Great. So to wrap up then, what are the best sources of information out there? You mentioned obviously your own blog, Undervalued Shares. What other sources of information might investors want to investigate if they're looking to kind of get to grips with the European markets?
I'd say really there are two different buckets or pillars of information. First of all, do follow the mainstream media because it's interesting. So what I just said earlier, it's not just interesting, it's relevant. And I'll give you a concrete example. What I mentioned earlier about this is a trend that will likely stay with us for years. That's not based on me just having an opinion. That's based on certain facts that have also been reported about recently in the likes of Bloomberg, the Financial Times, the Wall Street Journal, which is that large capital allocators have only just begun to put Europe back into the mix. And for example, BlackRock has announced they want to put $500 billion into Europe, but they're going to do so over 10 years, which means every year there's, on average, I guess, 50 billion from BlackRock flowing into Europe. You've had, which another one, Apollo Global Management has announced they want to put 100 billion into Europe, I think over 5 years, if I remember correctly. You pick up these news in mainstream media, and that goes to show that there is something fundamentally shifting. And yeah, you need to read the financial news for that. And then secondly, I'd say Substack is your friend. Substack and blogs, really, you can use these terms interchangeably. much as there's now less research from investment banks, there's now more research from very dedicated investors, analysts, market commentators who are publishing themselves on the internet, because that's how you do it nowadays. The game has changed. It's not just investment bank analysts anymore that you follow. You follow these independent thinkers who are making their ideas and their research available on the internet for relatively little money. I'm one of them, talking up my own book here. And I think that's really where you find the best opportunities and the best ideas right now, unless you want to research them all yourself.
Swen Lorenz, it's been a pleasure, and I'm sure we'll have you back on the show at some point soon and dig into these topics in a little bit more detail. But yeah, until then, thanks for your time.
Great, and I'd say next time we meet, let's dig into the German digitization opportunity. I think that's a whole subject unto itself. We should probably spend half an hour drilling just into that. So I'd say, to do a bit of marketing for your podcast, click subscribe, or whatever you need to do to follow this thing on YouTube. I'm a Luddite. I don't know how these things work, but be sure to check back if you enjoyed this podcast.
Great. Swen Lorenz, thanks very much. Thanks again to Sven for his time today. You can hear more from Sven at undervaluedshares.com and sarnia-am.com. If you enjoyed the show, then please do give us a follow and a like, and thanks for listening, everybody.